use CVP analysis to find break-even point and target profit volumes. So what is actually break-even point? So break-even point means sales level at which operating income is zero. If sales above break-even, then profit. If sales below break-even, then loss. So simply means that break-even point is to know how much sales that you're gonna make to get no profit, no loss. Okay, I repeat, break-even point means that you want to know how much sales that you make to get no profit and no loss, meaning that your target profit is zero. Okay, and then the second condition is you will meet break-even point if your fixed expense equals to total contribution margin. Okay, I repeat, you will get a break-even point. I mean, your profit target can be zero if your fixed expenses equals to total contribution margin. Okay, and then the next one is total sales equals to total expenses. Okay, you're gonna understand about this after we proceed to the next parts. Using unit contribution margin to calculate break-even point in units. So units sold equals to fixed expenses minus operating income divided with contribution margin per unit. Operating income here means target operating income. So for the break-even point, our target operating income is zero, right? Because we want to get no profit or no loss. So the target operating income is zero. And then fixed expenses is 7,000 from the previous slide. And then contribution margin per unit is $14. So the unit sold equals to 500 posters. So what does it mean? What does this figure means? So if you sell 500 posters, meaning that you will get break-even point condition. Meaning if you sell 500 posters, you will get zero profit and zero loss. Okay. And then next, using contribution margin ratio to calculate break-even point in sales dollars. This is break-even point in sales dollars, and this one is, the previous one is break-even point in units. Okay, break-even point in units, and this one break-even point in dollars. How to get that? The break-even point in sales equals to fixed expenses minus plus operating income, or we can call it as target operating income, divided with the contribution margin ratio. So 7,000 plus 0 divided with 0.4 contribution margin ratio. Okay, then the sales in dollars is 17,500. So if you make sales, if you get sales 17,500, then you will get the break-even point condition, no profit or no loss. Okay, remember this one is in dollars and the previous one is in units. Okay, and the difference is that only in this part. Okay, this one is for the unit sold. This one is contribution margin per unit, but for this one, contribution margin ratio. Okay. The next one, finding volume needed for target profit using unit CM. Assume that K wants to earn an operating income of 4,900. So he said that K wants to earn an operating income of 4,900. So this is one is target operating income, 4,900. So you just put these numbers into the formula. So units to be sold equals to 7,000 plus 4,900 divided with $14 equals to 850 posters. Okay, so what does it mean? Meaning that if you sell 850 posters, you will get profit or operating income for 4,900. Or with another word, if your sales is $29,750, your operating income is 4,900. Okay, so this formula you need to like remember and understand. Okay. So CVP analysis help managers determine what they need to sell to earn a target amount of profit. Okay, so these formula are very important for you because we always make forecasting like every time, usually like every month or every year, we always we always needs to make a forecasting or budgeting, something like that. So we have so this formula is very applicable in companies. So you really need to understand this formula. Okay, but during the exam you need to remember, like memorize, but the most important thing that you understand, not just memorize.